Okay, Assalamualaikum, selamat sejahtera. Okay, we meet again, okay, for BPK 20803, Keusahawanan, okay, on the topic of preparation of cash flow projection and financial statement. So I'm Puan Nur Aniza. Okay, so previously, I have already explained to you on how to prepare the cash flow projection of MZN M Enterprise. So now we're going to continue with the preparation of the other financial statements. Okay, so that is the income statement and also the balance sheet. Okay, so it is the same case that I'm going to use MZM. So we're going to continue, okay, with the income statement. So in the preparation of income statement, we are actually going to use another approach in accounting that is called the accrual accounting. Okay, so when we talk about accrual accounting, it means that you're going to look at when is the time the revenue is recognized and when is the time that the expenses is incurred. Okay, so it does not work in the same method as the cash accounting, okay, in preparing the cash flow projection, because under cash flow you look at when you pay the money and when you receive the money. So now we're not going to look into when money comes in or when money goes out, but we're going to look at when the action takes place. Okay, so we're going to disregard whether we receive any money or we pay any money out. We want to know when is the action when did the action took place. Okay, the timing, the period. Okay, so the previous question I have unhighlighted the unhighlighted the previous exercises, and we'll start fresh. Okay, so we'll start fresh so that it would be easier for you to follow. Okay, which one should be in the balance sheet and which one will be in the revenue in the income statement. Okay, so first of all, we're going to look at the income statement. Okay, so for the income statement, the formula will be, okay, revenue. Okay, so revenue, this is the revenue part versus expenses. Okay, so for the income statement, so I'm going to put the formula here. Okay, for the income statement, the formula will be revenue minus expenses. You will get the income. Okay, the net income. Okay, so what is the revenue? So revenue is actually it's the same. It's like the inflow, but it is the income coming in. Okay, so incomes will come from the operating income or also from non-operating income. Okay, so income can come from non-operating income and also operating income. So what does this mean? So it means that sometimes, okay, the company it has other income apart from their operating income. Okay, so usually operating incomes comes from the activities of the company. For instance, if it's retailing, so the main operation is retailing, so that is the operating income. And if the company, okay, or the organization have any other premises that it rents out, okay, so that is a non-operating income because that is not the main activity of that company, but then it has incomes from rent, and this comes from their non-operating activities. Okay, so income can come from income can actually come from that activities. Okay. Okay, so I'm going to put here revenue and then the expenses. Okay, so I'm going to um, erase back, okay, all the info that I have already put here. Okay, so that you can see how I put in the information. Okay, so in the exam, okay, this format will not be given to you. Okay, so you have to do the format. You have to draw, okay, or prepare the schedule by yourself. Okay, so here we're going to look into the income statement, okay, for January to March. So we're going to look it one by one. So we'll start with January. Okay, so look at the transaction here. Okay, so ZQ started a business, okay, on January 2018 with a capital of 50,000. Okay, so this is a capital. So this is an equity. So an equity is not an income. Okay, so it's not in the income statement. Okay, the business sells prepacked dried seafood, etc. Okay, and so forth. Okay, so in early January, the business rented a premise, paying a deposit of 2,400 and 800 rand in advance for January. Okay, so these are expenses. Okay, so for the income statement, and I will use, okay, also the highlighter, but I'm going to use other colors, okay, so that you will not be confused with the colors that I have used previously. Okay, so I'm going to use the blue one, okay, the light blue one for the expenses, okay, and a pink one, okay, for the revenue. Okay, so look at the first transaction. So it says that the business rented, okay, a venue, okay, and it has paid deposit of 2,400 and rent in advance for January. Okay, so what will be the expenses? Okay, so a deposit was paid. So the deposit is actually is actually a contract stating by the owner and also the renter as it's like a mortgage, not mortgage, sebagai cagaran. Okay, so it's actually apa nak kata cagaran, okay, it's actually a promise. Okay, so if in the future, if there is any default in usually it's for any default in payment of rent, okay, it will be taken from the deposit. Or sometimes when the rent period is coming to an end, usually the renter will not pay, okay, for the remaining months, okay, for that is in the deposit amount. Okay, for instance, if the deposit is for 2 months, then the renter will usually not pay for 2 months, okay, because they have already put a deposit. But sometimes the the owner of the premise, okay, will actually use the deposit to see if there is any kerosakan, okay, if there is any um, if to see whether, okay, the renter gives back, okay, the premise in good condition. So if it's not in good condition, they will actually take, okay, some of the amount from the deposit to betul kan, okay, to actually refurbish back the premise, okay, in good condition. Okay, so it's actually something that is withhold, okay, and will usually be returned back if there is nothing, if the premise is given back in good condition. Okay, or if it's not given back in good condition, then the amount will be used, okay, to do all the maintenance. Okay, so when there is a deposit, usually this is like to the renter. Okay, so this is actually um an asset. Okay, so it's actually an asset. Okay, and it's not an expense. Okay, so you pay cash, so it's an asset, and it's not an expense. So it will not be recorded in the income statement. It will be put under the asset. Okay, until the time when you are returning the premise back to the owner. Okay, and then that asset will be changed into an expense. Okay, so for now it's not an expense. Okay? So this is actually the method of prepayment. Okay, so a deposit is not an expense, but okay, the 800 rand, okay, the 800 rand, okay, so the 800 rand is an expense. Okay, so this 800 rand is paid in advance for January, but the condition says that um the rent should be paid, okay, in each month, okay, on the 27th. Okay, so this is the expenses. Okay, so in January, okay, there will be rent expense. Okay, so there will be rent expense because although it is paid early in January, okay, so the lease is due at the end of January. Okay, so you have to record it in January as an expense. So this is an expense. Okay, then we look at the second transaction. Okay, so this is on the recruitment of the workers. Okay, so the two workers were recruited in January and the monthly salary per worker is 600. Okay, so two workers in January and salary per month is 600. So this is an expense. Okay, so you have to take it into consideration. Okay, so for January, there will be two workers. So previously you have calculated uh, for the outflow, and because this is incurred in January, so this is an expense in January. So 2 times 600, okay, so the salary expense is okay 1,200. Okay, so the salary expense is 1,200 because this is the expense incurred, okay, that you use for January. Okay, okay, then in February the business received a grant of 15,000. So this is actually um a revenue. Okay, and this is received in February. So why do I say that a grant is a revenue? Because we cannot treat a grant as an equity. Okay, because um it's uh it's not actually an investment, okay, by it's not an investment by the government in the business, but this is actually money that was given out, and it's not and the government does not receive any benefits from the uh profits of the organization, so it cannot be treated as an equity, so it must be treated as a revenue. Okay, so it's actually an income. Okay, so because the money will be used for the operation of the company. Okay, so this is actually an income. Okay, so an income will be highlighted using okay the pink color. Okay, so it's an income, but the income is for February. Okay, so February. Okay, so 15,000. Okay, so you have to look out for in February there will be an income of this amount. Okay, okay. So now look at so in January there's nothing happening here. Okay, so now look at the following transaction. So it's about second-hand truck, okay, for business transportation. Okay, so this was purchased in March using a bank loan of 60,000 received in January. Okay, so a bank loan is not a revenue. Okay, so bank loan is a liability. Okay, so it's not revenue, it's a liability. The bank gave up a loan, but it expect you to return back its loan at a certain date. Okay, so it's not a revenue, it's not an income, but it's a liability. So this will be for this amount, okay, the 60,000 amount received in January, okay, will be reported in the balance sheet. Okay, now how about the purchase of the second-hand truck? Okay, so this is 30,000 and it was bought in by cash in March. Okay, so we are not going to treat this as an expense because a second-hand truck is an asset. Okay, so an asset is not an expense. Okay, so you're going to use the asset for uh, as a resource, okay, in the operation of your business. Okay, or the MZM is going to use the truck as a resource for its operation. Okay. Okay, so it's an asset. Okay, so asset is resources used, okay, in the operation, okay, in order to get profit. Okay, so you cannot treat it as an expense. It's not in the income statement. Okay. Now, there is installment repayment for the bank loan. Okay, that is 900 and it will start in April. Okay, so for bank loan, usually when there is an installment payment, this is actually uh, divided into two parts because usually in an installment, there will be the repayment of principal and also uh, the interest. Okay, so in the income statement, um, we will only record, okay, the interest part. Okay, the repayment of the principal will be recorded in the balance sheet. Okay, but for this transaction or for this month, okay, there is nothing to be recorded. And also for this business, it started in April, so it's not relevant. Okay. Now, we move on to depreciation. Okay, so the depreciation for the van. Okay, so this is not the van. This is the second-hand truck. Okay, so sorry, nanti sebutkan. Okay, so I'm going to change it. Okay, so this is a second-hand truck. Okay, so you change it in the question that I've already shared. Okay, so the second-hand, okay, truck. Okay, it is 1,000 per month. Okay, so now depreciation is an expense and it must be recorded monthly. Okay, so for every month you will have to record the depreciation, and because um the truck was purchased in March, okay, so you will start to record depreciation in March, so it's not going to be in January. Okay, so depreciation must be recorded every month, but then you will have to look at when did the uh, motor vehicle acquired or the equipment or machinery acquired. Okay, that will be the starting point for the depreciation to be recorded. Okay, so because it is now the depreciation will start, okay, in March because, okay, the second-hand truck was acquired in March. Okay, so it's not going to be recorded in the income statement in January and February, but it's going to be recorded in March. Okay, now we're looking at the total sales. Okay, so this is the activity of the sales for each month. Okay, so January 18,000, February 20,000, and March 27,000. Okay, so these are sales. So this will correspond to the revenue. So I'm going to put it as highlighted as a purple one, okay, a pink or purple one, okay. So depreciation here, sorry, I have not highlighted. This is an expense, but this expense will start in March. So it's still an expense, but then will start in March, okay. So just to start so this is in February. Okay. So here is the amount of credit sales for each month. Okay, and then there's a condition of the sale. So you said that it will be collected at the end of each month. Okay, and there are a few situations whereby credit sales will not be collected fully in February and also in March, and will be collected in the next month. So for the income statement, when the collection is made does not affect, okay, the recording of the revenues, because we are looking at when uh the action to receive the revenue happens. Okay, so for now we're going to look at what is the actual amount that should be the revenue amount that should be received in January. So we're going to take this amount. Okay, so for January it's 18,000, so the sales will be 18,000. Okay, so there is no other revenue, so this is the revenue, so the sales. Okay, so a sales. Okay, what is the amount of the sales? Okay, the total sales, the amount is 18,000. Okay, and then okay, so this is the condition. Okay, then purchase of raw material. Okay, so now we're looking at the purchase of raw material were on credit in January. Okay, and were on credit in January and February. It was 8,000, and for March, okay, the purchase was increased up to 3,000, okay, more than the previous month. Okay, so this is an expense, okay, the cost of goods sold. Okay, so this is cost of goods sold, okay, an expense. And the cost of goods sold, we do not put it under the operating expenses. Okay, we will usually less it from the sales, okay, from the sales under the revenue. So this is cost of goods sold, okay, the cost of raw materials. Okay, so for February the cost is 8,000, and January the cost is also 8,000. Okay, for March it will be 8,000 plus 3,000, it's going to be 11,000. Okay, so for January you will only put the amount 8,000. Okay, so this will be deducted. Okay, so this amount will be deducted from the sales amount. Okay, so I'm putting a bracket, okay, to show that this amount must be deducted. Okay, so bracket is the indication that you must deduct this amount. Okay, so now what will be the gross profit? Okay, so what will be the gross profit? Okay, so the gross profit will be 18,000 minus 8,000. Okay, the gross profit for January is 10,000. Okay, so I'm going to put it in the other column. Okay, so it will make it easier for you to minus and deduct, and it does not confuse you. Okay, so are there any other expenses, okay, that will have to be incurred, okay, in January? Okay, so there is another transaction here about the utilities expense. Okay, so this is an expense that will be incurred monthly. Okay, so this is an expense that will be incurred monthly, the utilities expense. Okay, okay, but there is also a situation here stating that for March, okay, 120 have been used but not have been paid. Okay, so this is not a condition that will be considered under the income statement, because we're going to see the usage. Okay, the usage of the utilities per month is 350. Okay, so whether you have paid it or you haven't paid it, it does not concern, okay, on the expenses incurred. Okay, so for January the utilities expense, okay, must be recorded utilities expense. Okay, so the amount that must be recorded is 350. So now you add up, okay, the amount, okay, 800 plus 1,200 plus 350, okay, so total expense here. Okay, so what will be the total expense? So add this up, okay, 800, 2,000, 2,000, 350, okay. So you will going to minus 2,350. Okay. Okay. So revenues less expenses. Okay. So look here, it must be less. Okay. So 10,000 minus 2,350. So the income will be 7,000. 650. Am I correct? Okay. So 10,000 minus 2,350. Okay. So that will be the net income. Okay. The net income for that month. Okay. So this is the net income for January. Okay, now we move on to the income statement of February. Okay, so I'm going to show you because here it involves a grant. Okay, so you will see here that under the revenue part, okay, so you're going to input. Okay, you're going to input the grant. Okay, under revenue. Okay, so list out, okay, the same expenses that will be recurring. Okay, so these are the expenses that will be recurring every month. Okay, only that sales cost of goods sold is the same, only that now you're going to add grant. Okay, because like I said previously, grant is treated like an income. Okay, so it's not an equity. Okay. Okay, so grant. Now we look here. Okay, so the usual thing is that, okay, and for every month, okay, the expenses will be for rent. Okay, so you have to state here 800 for rent. Okay, for February, and then that's the salary of the worker. Okay, so still two people. Okay, so 1,600. Tadi 1,600 and 1,200. Okay, 1,200. And then is there any depreciation? Okay, so no depreciation have not started yet. Okay, so depreciation have not started yet. So there's no depreciation yet. Okay. Okay, and is there any utilities? Yes. Okay, so utilities is still 350. Okay, because uh, even though because there is no expenses that have not been paid yet, and the expenses have already been incurred, okay, in February. Okay, so 350, so it's the same. Okay, now we're going to look at the sales. Okay, any more for February? Ada tak dicakap? Okay, so nothing here for February anymore. Additional information for February. So now we're going to look at the grant. Okay, so the grant is received in February. So 15,000 you're going to add. And then what is the sales for February? Okay, so February the sales is 20,000, but only collected okay, but only collected 18,000. So we are not going to look at the collection. So we're going to look at what should be the sales for that month. So it should be 20,000. And what is the cost of goods sold for February? Okay. So the cost of raw material for February is 8,000. Okay. So now what is the gross profit? Okay. So what will be the gross profit? Okay, so sorry, I should put the grant here, okay, in the next column, okay, just to segregate it and you can understand that that you will add up it later, okay. So put it there. Okay, so for the gross profit of the sales, okay, it will be from sales, it will be 12,000. Okay, so it will be 12,000. Okay, so it's different. So you can see the amount is different because that was for January 10,000, and for February the gross profit from sales is 12,000, and now you add with the grant, so the total gross income will be 27,000. Okay. So now what will be the expenses? Okay, the expenses is the same as the previous month. Okay, so the total expense. Okay, so the total expenses will be here 2350. So now what will be the net income? So the net income will be 27,000, okay, minus 2350. Okay, so what is the amount for the net income? Okay, so 27,000 minus 350, so it's going to be 26,000 650. Okay, it's going to be 26,650. So that, okay, eh, so not 26,000, 24,000. Oh, what is this? Allah Akbar, apa nak keluar ni? Sorry, what is this thing going on? Okay, so 24,650. Okay, so 24,650. Okay, sorry about the calculation and also the disturbance. Okay, so you can see that the net income for February is 24,650. Okay, so in the accrual basis accounting, when we calculate the revenues and for the net income, we're not going to actually bring forward, okay, the amount from the net income to the previous period to the next period. Okay, so we're going to start afresh. Okay, so that's why you will see that there's no opening balance or balance carried down to the next period. Okay, so this is for February. Okay, now we're going to see for March. Okay, so it's going to be the same also. Okay, but the difference here is that for March you're going to you're going to input, okay, the depreciation expense. Okay, so for March there are no other revenues. Okay, so you don't need to input any other revenues, but you have to watch out because in March, okay, there is actually depreciation. Okay, so there will be depreciation, and also for the utilities calculation. Okay, the utilities calculation although there are expenses that have not been paid yet, okay, it does not bother the income statement, because that is actually expenses that is incurred in that month. So whether you have paid it out or not, it does not affect the costs that have been incurred. Okay, so I'm not going to show you what is the amount here, because I want you to practice, okay, in calculating it yourself, okay, because this is also your assignment. Okay. Okay, and also watch out for the calculation of the March cost of goods sold, because the amount is not 8,000 anymore. Okay, so it has increased. Okay, so okay, better you put an asterisk or anything. Okay, March will be different or whatever. Okay. Okay, so just put it here. Okay, so the same goes also to the salary. Okay, so March amount is different. Okay, so this is just a reminder for you, so that for March, okay, don't forget that it will be different. Okay. Where is the expense for the worker? Okay. Okay. Okay, so you calculate it by yourself. Okay, now I'm going to show you on the preparation of the balance sheet. Okay, so in the balance sheet, okay, this is the format. Okay, so the format for the balance sheet is formula is asset equals to liabilities plus owner equity. Okay, so this is the balance sheet of MZM Enterprise. Okay, so this is for, okay, so this is for March. Okay, so 31st March. Okay, so for 31st March. Okay, so this is the format. Okay, you have to put, okay, the amount, okay, okay, under each category. Okay, so what will be the current asset? So the current asset are usually cash, accounts receivable, okay, cash, accounts receivable, supplies, okay, okay, intangible assets, okay. So usually under current asset, it is the asset that is going to be used up in 1 year. Okay, so that is why we call it as a current asset. Okay, so we already have the information, okay, previously from the cash flow statement for the cash amount at the end of the month. Okay, for March. Okay, so what is the cash amount for March? Okay, so look at the calculation here for March. Okay, so the amount, the closing balance is 129,550. Okay, so take that amount 129,550, because this is in March. Okay, so is there any accounts receivable in March? Accounts receivable is actually money that has not been paid by the customer. Okay, people are owing us money. Okay, so where do you find the information from? Okay, so usually it will be from the sales. Okay, so these are actually credit sales. Okay, so when we look at the income statement, we don't look at whether payment have been received or not. Okay, but now when you want to prepare for the balance sheet, you will have to look at any outstanding balance that have not been collected. Okay, so in March. So here it stated that in March, okay, so I'm going to use another color for the balance sheet. Okay, what color to use? Okay, I'm going to use the red color. Okay. No, I'm going to use the gray color. Okay, so the gray signifies all the transaction for balance sheet. Okay, so in March, it stated that 6,000 have not been collected yet from customers. So it means here that there is accounts receivable. Okay, we have not received any payment. Okay, from March. Okay, so the amount is 6,000. Okay, so this is accounts receivable. Okay, any more accounts receivable? No supplies. It didn't say anything about any supplies outstanding, so you don't have to put anything about the supplies. Okay, so after that, you can total up, okay, the current asset. So it will be cash plus accounts receivable. So 129,550 plus 6,000. Okay, so the total the amount for the current asset is 135,550. Okay, then we move to the fixed asset. Okay, so fixed asset is asset that can be used up for more than 1 year. Okay, so here the fixed asset is a long-term asset and it is the second-hand truck. Okay, so the second-hand truck. So what is the amount of the second-hand truck here? Okay, so the amount is 30,000. So this is the cost value of this truck. Okay, so it was acquired in March. So in March there will be a truck. Okay, uh, as the asset. So the amount of the truck is 30,000. Okay, and because it was acquired in March. Okay, so because it was acquired in March, then there will be depreciation for this truck. Okay. So what is the rate of depreciation? So now the depreciation rate is 1,000 per month. So here we're going to use the accumulated amount, okay? But because this is the first month, okay, there will be only 1,000. But if it's in the second month, it will be accumulated, okay? It means that you will have to add up, okay, the previous depreciation amount with the current depreciation amount to arrive to the accumulated depreciation amount, okay, because we're going to reduce, okay, the value of the asset, okay, through the accumulated depreciation. So now when you want to reduce the value of the asset, so you're going to take the amount of the net book value and the amount, not the amount of the amount of the accumulated depreciation. So because this was acquired in March, so the accumulated depreciation will be the same as the depreciation amount. Okay, so please be careful if on the amount of the depreciation, whether it's per month or per year. Okay, so if it's per year, you have to divide by 12. Okay, but if it's per month, then you can take the information as it is. Okay, so now this is per month. Okay, so 30,000 minus 1,000, so the net book value, okay, will be 29,000. So we're going to use the net book value to add up. Okay. So that is for depreciation. Now, are there any other fixed asset? Okay. So remember previously, okay, the company has put has put a deposit, okay, for the rent. Okay. So this is actually an asset to the okay, to the company. So why do I say that this is an asset and it's long term? Because it's not being used up for that month. Okay, so it's going to be used at the end of the rental period. Okay, so it's more than maybe the rental period might be more than 1 year. Okay, so why do I say that this is an asset? Okay, fixed asset, because one, the duration is more than 1 year. Okay, and then this is actually rent that you pay in advance. So deposit is actually, you can consider as rent that is paid in advance, because if your premise if the premise that you return is in good condition, then the renter um will not cut off any deposit for maintenance or refurbishment of their premise. Okay, so it will be used to pay for the remaining rent. Okay, so it's like an advance, so it is an asset for you. So you have to put the amount of the deposit. Okay, so it's going to be 2,400. Okay, so what will be the total fixed asset? Okay, total fixed asset amount. Okay, so 29,000 plus 2,400. Okay, the amount is 31,400. 31,400. Okay, so what will be the amount of the total asset? Okay, so it will be the amount of total current asset plus the amount of the total fixed asset. So if you have an intangible, if you have any intangible asset, you can put also under intangible asset, but there's no intangible asset. Okay, so now what will be the total of the uh asset? Okay, so 13550. Okay, 13550 plus, okay, 31,000 400. Okay, so the amount will be, okay, salah kira sekejap. Okay, 29,000 plus 2,400. Okay, 31,400 plus 135,550. Okay, the amount will be 166,950. Okay, so that's settled for the total set part. So now you have to find the amount for the current liability and the equity, and the amount must be the same as the amount of the total asset when you add the total equity and the liabilities. Okay, so now we're going to look at the accounts payable. So this is money that you still owe to people. Okay, so where is it? Okay, so usually this is the amount owed to supplier. Okay, so you can find it here. Okay, at the purchase of raw material. Okay, so it said that settlement to suppliers was paid in full the following months after purchase. Okay, so it means here that the purchase is done, okay, in March, but you have not paid it yet. Okay, because you will settle the payment next month, so you still owe money for your purchase. So what is the amount of the purchase for March? Okay, so here it said that for March the purchase will increase up to 3,000. So it means here that for March, okay, so you have to calculate for March, it will be 3,000 plus 8,000. Okay, so in your calculation, so the accounts payable will be 11,000. Okay, so you still owe 11,000. Okay, it's not been paid yet. Okay, because the policy is that you pay it in the future. Okay, so that is for the current liability. So you're going to pay it within that year. Okay, the next month. So it's a current liability. So the amount is 11,000. Okay, so is there any other current liability? Okay, so usually under the current liability, it will be accounts payable and also short term note payable. Okay, so it's under 1 year. Okay, so there's no other current liability, so the total current liability will be 11,000. Okay, so the total current liability will be 11,000. Okay, so there is no actually okay, so under current liability, there could also be services that have been amount of services or amount of goods that have been paid by your customer in advance that you have performed. But now it doesn't say anything that your customer have paid in advance, okay, for services that you have done. So it's not a liability for you. So if there is that situation, it comes under current liability. Okay. So now we look at the long-term liability. Okay, so the long-term liability will be the loan. Okay, so even though the loan was received in uh, January, okay, the loan was received in January. Okay, so bank loan, okay, received in January, okay, because you have a long time to pay for this loan and installment have not started yet, okay, it will be paid in April, okay, so you will have to put it under the long-term liability, okay, so the amount of the loan is 60,000, okay, so it's still there. Okay, so in balance sheet, you're going to put all the amount. Okay, and if you have made any payment, you will reduce it from the initial amount when you acquire the liability or the asset. Okay, so the loan is 60,000. Okay, so is there any other type of long-term liability? Okay, any other type of long-term liability? I don't think there is. Okay, there is any. Okay, so no more long-term liability. So the total of long-term liability is 60,000. Okay, so now what will be the total liability? So the total liability will be 11,000 plus 60,000 will be 71,000. Okay, so that is the total liability. Now we're going to look at the equity. Okay, so what is the equity? So equity comes from the owner. Okay, so it's the capital. So is there anything stated about the owner? Okay, so at the start of January, okay, the owner brings in capital of 50,000. Okay, so this is the amount that have been invested by the owner. Okay, even though it's in January, because it is still there. Okay, in the company. Okay, so for each month you will have to state this is the amount. Okay, so the amount that was brought in by the owner is 50,000. Okay, so you put the amount 50,000. Now what is the retained earning? Okay, so that's under equity, there will be retained earning. So retained earning is actually the net profit. Okay, after lessing any okay, after lessing any payment of dividends, okay, for the owner. Okay, so what is the retained earning for um for that company? Okay, in March. Okay, so the retained earning is actually adding up, okay, the income from month to one, okay, to get to the total to get to the retained earning for that month. Okay, so you will usually start with 0 and then you will add okay, and then you will add the net income, okay, for January. Okay, so the net income for January will be, oh no, where is it? Okay, so the net income for January, and then add, okay, minus any dividends paid, okay, or any drawings, and then you will get the new retained earning, and then add again uh, the net income, the new net income from the previous month, and then minus any drawings to get the new retained earning for February. Okay, and then use the amount, the retained earning from February, add with the net income of March to get the retained earning for March. Okay, so I think you're going it might confuse you. Okay, so now we're going to use actually just the net income. Okay, so what will be the net income for March? Okay, so we did not calculate it here. Why is it like this? Okay, so we did not calculate it previously. Okay, so I think you have to calculate it first. Okay, so the amount, then the total equity plus the liability you must get 166950. Okay, so yeah, I'm working backwards. Okay, but actually you have to see whether it's the same. Okay, because if it's not the same, then there is some okay, so there must be some information that is being missed out. Okay, so I'm going to work backwards. Okay, so 11,000. Okay, so if you want to know whether your calculation is correct, okay, you can work backwards because you already know that total asset must equal total equity and liability. Okay, so the amount must be 166950. Okay, so you have to less 166950 minus 71,000. Okay, then there will be 95,950. So minus 50,000. It should be 45,950 here. Okay, so if you want to check whether it is correct, okay, so we can look at the income statement of March. Okay, so it must be this amount. Okay, so check balik. Okay, so terpaksa dah saya tunjukkan juga. Okay, so now we move back to prepare. Okay, oh wow, what is this? Kenapa asyik lari je? Okay, so kita kena prepare jugalah. Okay, untuk March. Okay, so the March sales revenue is, oh, what is this? Okay, 27,000. Okay, the cost of goods sold is actually 11,000. Okay, so the amount will be 16,000. Okay, so there's nothing else. Okay, then what is the rent expense? It's 800. Salary expense, okay, because only one worker, 600. Depreciation expense, because there is a truck, that month will be 1,000, and the utilities expense is 350. Okay, so what will be the total of the rent expense, the total of expenses? Okay, so 800 plus 600 plus 1,000 plus 350. Okay, 2,750. Okay, so it's going to be the total expense will be 2,750. Okay, so this is total expense. Okay. Okay, so what is the gross profit? So here the gross profit is 16,000. Okay. Okay, so nothing much more is different. Much more is different. Okay. Okay, so now 16,000 minus 2,750. So the amount is, okay, 13,250. Okay, 13,250. Okay, so this is the net income for March. Okay, so now you want to know what will be the retained earning, okay, for March. Okay, so retained earning is calculated, okay, as this way. Okay, so retained earning will be opening retain. Okay, opening retain earnings. So it means the retained earnings from the previous month. Okay, plus the net income for that month. Okay, and then minus any drawings if this is an enterprise, if it's a shareholding company. So if there is any dividends, okay, drawings or dividends. Okay, and you will arrive to the new return earning. Okay, closing retained earning, and this amount will be will be recorded in the balance sheet. Okay, so this is formula in calculating the retained earning. Okay, so now we look at January. Okay, so January, the opening retained earning, there's nothing because it has just started. Okay, so January, the net income is, what is the net income for January? 7650. Okay, 650. There's no drawings. Okay, so the new retained earning will be 7650. Okay, then for February, okay, I'm just duplicating this. Okay, so it will make my work easier. Okay, so February. Okay, so the opening retained earning is 7650, and what is the net income? Okay, the net income is, what is the net income for February? 24650. So 24650, and there's no drawings. Okay, so the new amount will be 7650 and 24650. So you add it up. Okay, 7650 plus 24650. Okay, so you will get 32,300. Okay, now for March. Okay, so you're going to use this because you want to take the amount of the retained earning here. Okay, so March will be 300. Okay, plus. Okay, so what is March? 13250. Okay, 13250, and then minus a 0. Okay, because there's no drawings. Okay, so it will be 300 plus 13250. Okay, 45550. Okay, so that should be the amount of the retained earning. Okay, so now let's see, is it the same? Oh, okay, so let's see if it's the same with the amount that you have calculated below. Okay, so it should be 4550. Kalau tak betul, okay, 45950. So it means that there is something that I have left out. Okay, 45550 with 45950. Okay. Okay, 400. Where did I left it out? 400 is left out. Okay. Where is it? Salah add ke? Okay. So let's see whether my addition is correct or not. Okay. So 129550, 6000. Okay, so it means here it should be 45550. So what did apa yang dibuat benda ni? Okay, so here I must have left out something up here. Okay, so what is the addition? Okay, whether the addition is wrong. Okay, depreciation 1,000 utilities 1,200, 1,200, 350, 2,350, 2,350. 100, 800, 126, okay, 250, 250. Okay, so the income statement is correct. Okay, 16,800, 1,400. Okay, 1,400 total. Utilities, salary expenses, 600 betul ke? 8,000, 3,000. Okay, so what is wrong here? 2,400 ada tadi. 8, 1,000, 1,004. Okey, 1,004 campur 1,000, 2,004, 2,750. Betul tak saya punya addition dengan subtraction? Okey, tengok balik. 800 plus 600. Okay, plus 1,000 plus 350, 2,750 minus 16,000. Okay, 13,250. So this is correct. What is this problem? Okay. So this is correct. This one, 27,000. Okay, so 800 plus 1,200 plus 350 to 350 minus 7,000 24,650. Okay, so this is correct. Okay, and here 10,000 minus 350 7,650. Okay, so the amount of this thing is correct. Okay, so it might be the amount for the cash. Okay, so addition of the cash, what is incorrectly calculated because it involves 400. Okay, the difference of 400, 145,900. Okay. Okay, so calculate 50,000, 6,000, 18,000. Okay, so better calculate back. Okay, so because it might be wrong somewhere here. Okay, 18,000. So 1 to 8,000. Okay, then 15,000 plus 18,000. So 23,000, 23,000. Okay. The deposit. Okay. So in January 2,400 plus 800 plus 1,200 plus 350 or 750. Okay, 800 plus 1,200 plus 8,000 plus 350. So this is okay. And here 800 plus 600. Okay, plus 30,000 plus 8,000 plus 350 minus 120. Okay, plus 130. Okay, 39. Okay, it should be 39530. Okay, so this is the error here. Okay, so 800. Okay, 800 plus 600 plus 30,000 plus 8,000 plus 130. Okay, 39530. 39. Okay, so I did an error here. 39530. Okay, so the amount of the cash should be 145,900 plus 23,000 minus 39530. Okay, so 129,370. Okay, so it should be 129. Okay, 370. Okay, 129,370. Okay, so that is the amount, 129,370. So 129,370. Okay, so add it back. Okay, 129,370 plus 6,000. Okay, it will be 135,370. Okay, then plus 31,400. Okay, 166,770. 770. Okay. Okay, now 11,000 plus 71,000 plus 50,000 plus 4550. Okay, 455 455 5550. Okay, 17,550 177. Okay, jap. Okay, the calculator 50,000. Oh, sure. 50,000 plus 45550. 4550 to 4550. Okay. So the total equity is 95,550. Okay. 95,550 plus with 71,000. Okay. The amount is 16550. What is the amount here? 166,550. Huh? Okay, so there is actually a discrepancy here and I cannot find the amount. Okay, what is the amount that makes the difference here? Okay, so calculate balik semula 129,370 ke? What did I go wrong? Okay, so 750. So I think this is correct. The income statement is correct. Okay, so only the correction here is in the cash flow. Okay, so something is wrong in the calculation. Okay, so 128,000. 128,000 plus no, 128,000 minus 4750, 123,250, then plus 33,000, okay, 156,250, minus 10,350, 145,900, plus 23,000, okay, 168,900, minus 39,530. Okay, 129,370. Okay, so the amount is 129,370. Oh, I forgot one thing. Okay, so I left out one thing. So this is actually a liability. Okay, sorry. That's why it does not balance. Okay, so it's actually a liability here. Okay, so for sorry. Okay, so there was mistake in calculating, okay, the cash. And now for the current liability, okay, so remember that in March, okay, 120 of utilities have not been paid yet. So it means that you still owe, okay, you still owe money to a creditor. Okay, so the creditor is actually utilities payable. Okay, so you still owe money. So there is another thing here. So utilities payable, that is the amount is 120. Okay, so here it will be 11. Okay, 120. So the amount here will be 1120. Okay, so now that is why there is the difference. Okay, so it will be 71120. Okay, so 71120. So now 71120 plus 9550, uh 71120 plus 9550. Okay, the amount will be 166670. Okay, so sorry for that. Okay, so sometimes, okay, there will be errors. Okay, so you see here that I made some errors in calculating the cash flow. So when you make, okay, an error like that, okay, it's called the transposition error, whereby it should be 129370, but then I put it as 129,530. So that's why the amount was different. And also I forgot on the utilities payable, okay, the amount owing. Okay, so that is why the liability side does not balance with the asset side. Okay, so now the balance sheet is balanced. Okay, so it's in preparing the balance sheet, why is it like this? Okay, so in preparing the balance sheet, actually you have to understand a lot of things. Okay, so in this short time, okay, you might not understand actually what is happening. So for those who have taken accounting, okay, they might have an advantage. Okay? So and in preparing balance sheet, it will require you more time to understand, because if there is any information that is left out, you will find that your balance sheet will not balance. Okay, so don't worry about this. In your final examination, in your final test, okay, balance sheet is not included. Okay, so it's going to be up to income statement, and you're only going to prepare for 1 month only. Okay, so that's all for the financial part. What I've shown you is actually about 80% of the calculation for in preparing the uh, financial statement in preparing the financial part for your test. Okay, so 80% of the workings, okay, and another 20% is actually mathematics. Okay, that is when you have to come up with the numbers of the actual sales, because it's not going to be because what I can say is that you have to calculate for the sales. Okay, it's not going to be given. Okay, so that is the difference for the test question in this semester. Okay, so good luck for your exam. Okay, so in calculating, what I can say is that when you want to calculate for the amount of sales, okay, so you actually have to times, okay, the unit of sales with the sales price. Okay, so that is what I can tell you. Okay, so good luck to all of you. Okay, so thank you.